Welcome to the True Wealth Podcast, where we specialize in helping aspiring homeowners break into the real estate market and help investors create and build wealth through real estate. We will be sharing some of our best advice around real estate so you can purchase your first home or reduce taxes and achieve financial freedom. Your host, Seun Adeyemi, is a certified financial planner, mortgage professional. Financial freedom is possible when you have the right mindset, coaching, advice, and community. So, let's get real.
Welcome to the True Wealth Podcast. I'm your host, Seun Adeyemi. Today we are joined by Dmitri. Dmitri is from Share. This is part 4 of our conversation on real estate investing in the US. The first part we talked with Andrew discussing why the US real estate market is something worth looking to. Part 2, we had a conversation with Carmen on the different tax structures and the proper ways to, or the different ways to hold your real estate if you do buy real estate in the US. And part 3, we spoke again with Andrew talking about the different financing options available for Canadians who are looking to purchase real estate in the US. Part 4 here is with Dmitri, and we're going to be talking about the metrics to look for, profitable foundations, mastering real estate metrics for success. What are the kind of numbers you should be looking for? What do those numbers mean? Is this going to be profitable? Is it not going to be profitable? How do you ensure that you're going through this or you're going into real estate investing with eyes wide open and you're making the right decision for your family? Dmitri, how are you doing today?
I'm good. Thank you so much for having me. I'm excited to have this chat with you today, and I look forward to everything we have to cover.
It's all about the numbers, right? If you're going to go into real estate, if you're going to buy real estate, whether that's in the US, whether that's in Canada, I'm biased right now. I'm not a fan of the Canadian market, so the US market looks very lucrative. Obviously, it has its challenge. It's had its challenges over the years, but I know people who have made money regardless of the market. And part of being able to do that is knowing your numbers. Numbers. It's got to make sense. So let's dive into the metrics. Purchase price, I think, is the first one that an investor needs to be mindful of, right? When you're buying real estate, the price has got to be right.
Definitely. I mean, you always want to make sure you're getting in on the right basis. And there's a lot of tools, you can use to really evaluate if you're paying the right price. Ultimately, real estate is a market-driven investment class. A lot of the times, what properties nearby are selling for, what's the right price, but you have to be factoring in, the property-specific elements as you evaluate opportunity on a case-by-case basis. And buying well is definitely a very big component of a successful real estate investment.
And one of the parts to buying for the right price is also based on location. And location plays a key factor in whether or not the purchase price you're paying is going to be profitable. Can you talk a little bit about that?
Yeah, obviously, every market is going to have, different drivers, different fundamentals. And ultimately, for a single family home, which, is where we're focused, it's going to have different, drivers from a rental standpoint. So how much are people paying in rent? So ultimately, you want to make sure you're evaluating all of those factors, really, focusing on both the macro drivers, the micro drivers, and making sure, you're buying relative to what you're currently seeing in the market and what you see as kind of the forward-looking trends.
So when it comes to the different classes of properties, typically the purchase price and the class of the property matters into profitability when it comes to what's the game plan? Is it cash flow? Is it appreciation? Can you talk about the different classes and the price ranges and why price is a big factor in determining what asset class or what type class of property you should be looking at?
Yeah, definitely. So, I mean, every investor is going to have, different targets and, a different plan in mind. So obviously, with our clients, what we do is, that's the first part we want to understand about them. what is their long-term plan, what are their goals, their timelines, and ultimately how can we get there. And if someone
Mm-hmm.
is very focused on cash flow, you're going to be looking for those higher yielding properties, right? We'll probably get into talking about cap rates and things like that, which obviously play into evaluating a real estate investment. But ultimately, if you're looking for a higher cap rate, you're probably buying potentially at a lower price point, where you're generating more of that yield, and part of that comes with some of that risk, right? And ultimately, what we definitely see is as you go higher on the cap rate, or in a sense, like, higher on the yield that you're trying to get from the investment, you're typically getting into a riskier asset class. And those
Mm-hmm.
deals, generally speaking, over the long term, we'll see less appreciation, right? They might be older properties. They may be, in a smaller market. We talked about already how market definitely plays into, effect when it comes to
Mm-hmm.
pricing and the rent. So ultimately, if you're buying something in a smaller market or in a more inferior location within a market or something more tertiary, you might be getting compensated with better yield, but you may be sacrificing some of that long-term appreciation. Now, on the flip side, if you're getting into, a very desirable market, very liquid, once, it's a newer property, so, carries less risks associated with it, those properties may be located in more desirable neighborhoods, right, with better schools, more demand from both renters and buyers, and ultimately that's going to drive competition, and that's going to potentially increase the price that you're paying for it, and ultimately you may you'll likely result kind of generating less cash flow or less yield off that type of investment. But over the long term, those location and market factors will tend to allow that investment to appreciate at a faster pace over the long term. So again, definitely, important factors to consider, and something, we evaluate with a client on a case by case basis to make sure what's, most appropriate for them based on, their access to capital, but also based on their risk tolerance.
So is it safe to say that typically, not in all cases, if the property's cheaper, y- most times you will probably generate more income, rental income, but less appreciation because those are typically older neighborhoods and older houses. And then for the higher the purchase price for the property, the less the yield, the less ongoing income you're going to generate, but it also means potentially the higher the appreciation on the back end.
Yeah, again, obviously not everything is, as simple or as uniform as that. And ultimately, when you look at the investments and you talk about a lower price and a higher price, there's limits to that, right? You
Mm-hmm.
still want something that is, a single family rental, right? A property that is best utilized, for an investor as a rental versus, going into maybe like, higher price points where we're talking luxury, or
Right,
certain
right.
markets which will have different fundamentals. So
Mm-hmm.
factoring that in, if you kind of look at where our target properties are in these different profiles of homes, A, B, and C is how we group them. We're still kind of at the high end, we'll be pushing maybe $400,000 purchase price, right?
Mm-hmm.
So if you kind of constrain your your framework with that in mind, then yes, what you said is generally accurate, and that's how we typically see deals price out, especially kind of in the markets that we're in.
That was my follow-up question. Like, do you have a ceiling that you would typically look at in terms of purchase price, just so that we can still keep those numbers in line? And you said typically you look on the high end 400K, which sounds about right. And
Mhm.
the low end, I guess it all depends on
On
not the
the
price alone, but just the ability for that property to still generate a little bit of appreciation on the back end of it.
Yeah. Yeah, look, even if we're getting into, the lower price point markets and, deals that, will generally have more risk associated with, we're still selective on where we're buying, both from a macro standpoint, but also from, the neighborhood and the street it's on and so forth. But ultimately, yeah, we're going up to like in and around 400,000 in some cases. And then on the low end, again, it will really be dependent on the market and ultimately, on our clients, financing strategy, because you need to be at a certain kind of quality of product and a certain price point to actually be able to get financing. So
for
again, that kind of gets into the all cash buyers or not approach as well.
Right, because the more, or rather, the less desirable the property is from a price point and marketability standpoint, the harder it is to get financing typically. So that means that you may have to, in those cases, probably see if you can buy the property cash, because maybe it needs a lot of fixing, it needs a lot of upgrades. Financing becomes more expensive, and so it's better to probably just buy it cash, clean it up a little bit, and then maybe put it back, refinance it, so that now you can go to traditional lenders to finance it before you now put it into the rental market and you could probably even generate a lot more rental income using that type of approach, which goes to our second question, rental income.
And definitely, and just to kind of add to what you're just alluding to is, there's obviously the component of, the deal has to be in the right, physical condition to actually have a lender, provide you the financing. On top of that, there are just, minimum loan amount requirements from lenders. So again, if on the low end, if, we have a partner that will not lend, less than $75,000 on a, debt service coverage ratio loan, then, you can't be buying an $80,000 property, right? Because it's not going to meet their down payment requirements and so forth. So again, you might have that property be livable in the right market and generally be okay for financing, but you'll run into some constraints there as well. So a few kind of key things for people to keep in mind as they explore opportunities.
So rental income, obviously that's a big thing that most people are familiar with. Can my property generate enough rent to cover my expenses, my mortgage, my property taxes? Let's look at that a little bit more detailed, from a detailed perspective, beyond just the income, potential rental income. What other facets do you typically explore when you're viewing this metric?
Yeah, I always it's a great question, because I know a lot of the times in the industry, and a lot of people will look at what is the rent ratio to the purchase price you're paying. And again, not that that's a bad metric to look at, but every market is different, right? And when you start factoring in large expenses, such as property taxes, you're going to be paying very different property taxes, relative to your purchase price or the value of your home in Texas versus Alabama, right? So if you looked at just the rents on the properties relative to the prices and compare an apples to apples on that case, you're not going to have the same cash flow generate relatively, because there's going to be a lower lower net income generated from the property. So it is important to really be granular and actually factor in the the various expenses and allowances that are going to be applicable when you own the investment. And again, we definitely try to underwrite as granular as we can. A lot of times you are making allowances because things don't necessarily work in a straight nature, and you're going to have variability year over year. But when you look at things from a long term viewpoint, and ultimately when you look at the law of averages on a large portfolio, you can get some good benchmarks on where operating metrics need to be, and where you need to be accounting for on the expense side and on the allowance side. So for instance, you're looking. So I just kind of wanted to list out a few of them, right? So you're obviously looking at where are the rents, how does that compare to, the market, the properties, and so forth. But you are, allocating a vacancy allowance, right? There's always going to be some properties that are running vacant in the market, and different markets will have different vacancy factors, right? So you want to account for that every year. It's like I said, it's never going to be the number that you estimate, because some years you're going to be fully occupied, and some years you might have 30 days to reach out in the property. Ultimately, over the long term, you're applying a vacancy factor every year. You want to look at what are your taxes, right? Now a lot of counties will reassess, right? So you want to factor in your purchase price and what the burden you're going to be paying every year for the realty tax assessment. You want to know what is it going to cost you to insure the property, right? So you want to factor in the insurance costs. You want to have an allowance for repairs and maintenance, and have some reserves allocated into your cash flows. If you're utilizing third-party property management, you need to know what are the fees you're paying, what is their structure, and a lot of times they're taking a percent of rent, and that's what people are kind of estimating when they look at the property management expense. But we all know property management contracts also have leasing costs and renewal costs.
That's
you
right.
You want to allocate, some of that, because if you're placing a new tenant, you're not going to see the full year of those rents. You want to, factor in costs that are associated with that. Obviously, utilities, right? Most of the time in our markets, the tenants paying utilities. So you will think, hey, that's, zero, but it's not, right? There are going to be periods of times when you're doing renovations, when you're doing, leasing, where the owner is going to be paying for those deals. Maybe they're not, very large or overly material, but again, you want to make sure, you're factoring that in. And, hopefully I'm not forgetting any, but that's typically, kind of all the line items that we break down as we look to estimate, that net operating income and ultimately evaluate the cap rate that we're buying the opportunity at.
So let's explain what the net operating income is. I know we've kind of talked about it, but let's break it down for the newbie investor. What's the net operating income?
So it's basically looking at your rental revenue less your operating expenses. So again, really focusing on, what is the income that is being generated by the property, right? So again, that will be kind of inclusive of all the items I had just mentioned. And I specifically, stopped short of talking about, some other factors, some other items that are included overall in your cash flow, when you talk about debt and so forth, asset management fees, etc. But from a net operating income, it's, the word operating is key. It's really your rental revenues less, what your, operating expenses are.
Right. And so typically when investors are looking to buy investment real estate, I always say treat it as a business, right?
Mm-hmm.
What's the cost for me to generate the revenue that I need to generate? So if I need to generate $2,000, or if I'm generating $2,000 from this rental property, what is it costing me on a monthly basis to do that? So those are the things you mentioned: vacancy rates, property taxes, property management, insurance, maintenance, leasing costs. And these all have different variations in terms of what you apply. Vacancy rates could be different, could be anywhere. Typically, I see, at least on the Canadian side, 10 to 20% vacancy rates. Different counties, different states have different vacancy rates. And so each of this operating expense have different metrics with which you use to apply an estimate. And like you said, it's never going to be a perfect number to use, but we look at law of averages when we're looking at these expenses.
Yeah, I think that's a very high vacancy rate. So typically, you're not underwriting that. Again, if you look at kind of where the markets operate, right? Like ultimately, again, with vacancy, yes, if your tenant turns and you have to do, some work on the home and then get it released, may take 30 or 60 days or so forth, you're going to have that vacancy percentage you just mentioned. But ultimately, generally speaking, you see tenants in single family rentals staying for, a number of years. So in residential space, typically what we're seeing are markets operating in the, high 90s, maybe, like 97, 96, 97%, down to kind of the low 90s where, maybe on the high end, you're applying an 8% vacancy factor. Again, there's data, there's a lot of large institutions that own scale that are reporting their metrics public. There's, research that's done to really kind of understand, the, where the market's operating at. So you kind of use those, averages from, a large set of data and really, again, allocate an annual allowance. Ideally, it's always occupied and you get that tenant that stays there for your entire duration,
3 years,
which is
4 years, 5 years.
Yeah, a lot of times longer as well, because, part of the reason that makes the asset class attractive from an investment standpoint is obviously the affordability challenges that you see, and people having to rent more than they can afford home purchases, which makes the rental product very important to provide people with a quality living situation.
So let's look at the different return metrics, right? So we've mentioned a few terms here that I want kind of defined for the average investor, for the new investor? What's a cap rate? What's cash on cash? Everybody knows return on investment. That's pretty simple, but let's break down this other term so we know what to expect.
Yeah, so a cap rate, I mean, that's really kind of the universal tool in the world of real estate investing for evaluating a real estate deal. So it's what it's really looking at is that net operating income, right, which we just defined, relative to the purchase price. And really, the purchase price should really be your purchase price, and then the cost of any deferred maintenance you're doing to the property to actually get it into the condition at which it's rented, right? So we would call it your all-in cost, so purchase price plus renovations.
Plus renovations, plus closing.
Yeah. Usually closing, you don't typically include, it varies. We don't typically include because again, it will vary. Like that's something that will vary a little bit based on the owner, the structure they're buying in.
Right.
To a certain degree, are they getting financing or not? It's meant to kind of really straight line. So you can compare, a single family home investment on a cap rate basis to a office building on a cap rate basis, right? It is that universal tool that allows you to really price and understand things, compared to each other. And ultimately, if you're buying at a higher cap rate, you're getting more net operating income. And if you're buying at a lower cap rate, you're getting less.
That's
and a
right.
big driver in that, cap rate, really understanding it is to some degree your risk return, but also the growth that you foresee in the investment, right? So an investor will pay a lower cap rate if they feel it has better growth in that investment.
Correct.
Ultimately, and that kind of ties back to our conversation right at the start about, higher yielding properties, a little bit more risky, lower yielding appreciation, and so forth, is ultimately, if you're buying at a lower cap rate, but you see rents, really skyrocketing in that area or in that market over the next 3, 5, 10 years, you're willing to pay that lower cap rate, right? And obviously, the actual real estate investment type factors into it. You'll pay a lower cap rate for, a residential property, versus, maybe, a suburban office or et cetera, right? So again, obviously that, risk and growth potential factors into the calculation. And that's why the cap rate is really a key metric. Because again, it also, just to kind of allude to it one more time, is it strips away, the deal specific, structures and financing, et cetera. It really just looks at the underlying real estate aspect of things. So, what is your all-in cost and what is the net operating income you're generating?
Got you. So there's also return on investments. I'm not going to go into that, but let's talk about cash on cash return. What's this? How do you calculate that? And what's the significance of that?
Yeah. So cash on cash is, taking, that cap rate and going a little bit further with it. But again, now you're really assessing the profitability of the investment. So now you're looking at what is the cash I'm generating from this investment? And that's going to be now net operating income that you're taking away. What is that, interest and principal expense you're paying? In our model, we, asset management costs are included in, cash flow. Really kind of getting down to your net cash flow number. But now you're looking at it, not based on purchase price or your all-in cost. You're looking at it based on the equity you invested. So, more often than not, you're not buying real estate, full cash, right? There are reasons to do it. And, today's climate is definitely, getting more people to, temporarily hold things on an all cash basis. But ultimately, in general terms, you're using leverage. You're trying to use someone else's money to, scale your portfolio and purchase the property. So the cash on cash really evaluates the profitability based on the cash you're getting out of the investment relative to the cash you put into the investment.
So with the cash on cash rate, you're factoring in your cost of acquisition, you're factoring in the other aspects to that whole deal. So financing costs, principal and interest. If your down payment is coming from a HELOC, then you're factoring your interest rate that you're paying on that. So you're factoring all the other ancillary costs outside of just the specific property itself.
Exactly. And it's it's an important tool because again, you might be looking at two different investments. You might be getting different financing terms on them. Some may
Hmm.
require more cash to put down. Some may be in a market that has higher costs, whether it's title or so forth, right? You're really kind of going down to that, profitability comparison basis where you can look which one is going to be generating me a better cash on cash return, especially if that's, what you're really factoring as, the key metric for your decision. And obviously as we've talked about, there are multiple things to look at when you're deciding which property to buy and where.
Hmm. I think for the newbie investor or somewhat seasoned investor, I think the cash on cash rate is a really good metric to look
Mm-hmm.
at in terms of long-term projections, especially because if at the beginning you're starting out and you don't have a lot of cash, it also means that you're applying a lot more leverage. It's important to do your due diligence to ensure that that leverage and all the other aspects of the financing are factored in to help you make a good informed decisions. So we've talked about NOI,
Yeah.
net operating income. We've talked about cap rate. We've talked about cash on cash rate. Uh, any other metrics do you want to
Yeah.
touch on?
Yeah. So I think what you just said about cash on cash is important. It's accurate. But again, the cash on cash will have some limitations in the way it kind of looks at things. Again, being, ignoring really the aspect of time value of money, which is why
That's
when
right.
we look at things, obviously cap rate, as I mentioned, is a big big
Mhm.
metric that we're focused on. But really, when you look at returns, we're focused in on a metric that is again more comparable with the ROI, but it's called IRR. So
That's
the
right.
IRR,
Internal rate of return.
yes, yeah, return. Really, it's like like you said, internal rate of return, and that's really looking at things similar to a cash on cash, but it's factoring in the time value of money. So you're looking at, what is my outflow of cash initially? What am I putting into this investment? And then, at each time period, what am I estimating that I'm going to have as cash outflows?
Hmm.
Cash outflows. So, that's again your net operating income after you're looking at, principal and interest, some management expense and so forth, and looking at that, as it grows over, your investment period horizon, let's say it's 10 years, and then estimating, what am I going to get as, my disposition proceeds? And then
Right.
saying, what the IRR really calculates is if you lay it all out, and again, you use Excel, it's a more kind of, sophisticated formula, but you're basically calculating that discount factor that will take all of those, cash ins and outs over the whole period to a net present value of zero. So basically saying, what is the return you're getting on that initial cash outflow every year based on this investment. And again, this allows you to, really compare investments side by side, not just within single family, but across other classes, really factor in risk return, but also allows you to kind of understand what you're doing a little bit better. Because to your example, if you're buying on a home equity line of credit that's at a 7 or 7.5% interest rate per year, right? Like, and you're getting an IRR of 5% per year, like that's not good, right?
Well,
You're putting out 7.5% money and generating 5% per year, right? You want to make sure you're kind of generating or anticipating to generate a return on investment that's going to be better than what you're going to be able to do elsewhere, and also better than your cost of capital, or in a sense the risk-free interest rate that you might
interest rate.
get from a savings account, right? So again, that's why we really focus on IRR. And again, that's really kind of that institutional metric that you will
Mhm.
see, used by, the large pension funds, the large asset managers. And that's really, in a lot of cases, how people are compensated, right? Is, above that annual return
I
that
know
you're
return.
generating is when, the asset manager will take like a portion of profits, et cetera. And that's, again, a key indicator on why it's a very important metric. And again, every one of them has their limitations. Nothing is the only thing you should focus it on, but ultimately that's a key one that we underwrite our deals on, and ultimately use to compare investments and markets and different types of profiles of homes.
I like the RR because it allows you to make an objective call on, okay, do I do real estate investing? Do I do stock market? Do I do both of them? Do I invest in private equity? Do I invest in private businesses? Do I invest, like, what's my total return compared to my outlay? And I can compare it to what there's also the opportunity cost of doing absolutely nothing, not investing in real estate.
And the risk associated with each of them, right?
Each
So
of them.
yeah, so right, obviously if you're getting into a riskier investment, you should be anticipating a better IRR.
Yeah. So, I mean, I think this is a conversation that there's so many layers that we can peel and we can talk about and probably go nerd out on. But just to make it to make it very simple, these are at least 4 or 5 simple metrics that at the barest minimum you should be looking at. You should be looking at your rental income, you should be looking at NOI, you should be looking at cap rates, cash on cash rates, and IRR rates. And I believe this has been very informative. Dmitri, was there anything else you wanted to add to this before we wrap up?
No, I mean, I think, in terms of the metrics, we definitely covered, the key things. Again, I think it's always important for people to, do their diligence on their investment, really kind of understand, what are their, internal preferences, internal goals. Ultimately, again, you made a good point, evaluating investments against each other. Do you want to go real estate? Do you want to go equities and so forth? I think, we're very big believers in diversification. I think that's always important to say. And obviously, in our realm, that's, within the single family investment space, but I think that should be applied even more globally on an individual basis. But, from our sense, right, like when we help our clients build a portfolio, part of why, we set out to do what we're doing, and part of, the value add we really feel like we're adding as our clients invest to it is the ability to instead of buying, 3 properties in your backyard, actually have 3 investment properties that are in 3 different markets, that have different drivers, that may have, things that, you can't foresee. We don't know where the next big job announcement is going to be, or, which area is going to, change some tax laws that will make things more advantageous, right? So having that diversification and ultimately allowing yourself to ride out some of that, market by market volatility that you're always going to see, right? Rents are going to rise faster in certain years than other years, especially, in, areas where, there's, supply and demand equilibrium, and when things are really good, there's more stuff being built. When things are bad, right? Riding all of that out and having that diversified portfolio is key. And I think that's why it's important to work with, people that are knowledgeable in the space, having mentors, having, people that you can really, look to help guide you as you make those decisions. And I just wanted to make sure I mentioned that because, again, I think that's very important, and that's something I definitely follow myself as I invest.
Absolutely. And that's why I believe this partnership works, because while Share is looking at the different metrics within the real estate markets, and even diversifying within real estate, True Wealth, myself as a financial planner, I'm looking at not just real estate, but I'm also looking at, as much as I love real estate is not the only thing I tell my clients to invest in. It's also having that outside diversification. And we're able to look at the full big picture from where you're coming as an investor, what's good for you. Does real estate play a role in your overall portfolio? And if it does, what does that look like? And even within real estate, how do we make sure you're diversified? And that's part of what Share does to help you, give you this holistic investment opportunity to help you build and grow wealth.
Yeah, definitely.
Dmitri, thank you very much for your time. I really appreciate it. You and I can probably go ham on this numbers.
Definitely. Thank you so much for having me. It was a blast, and I'm glad we got to dive into all of these metrics.
Thank you very much. You've been listening to the True Wealth Podcast. Talk to you next time.
This is all the time we have for today. Thanks for listening to the True Wealth Podcast. Don't forget to rate, share, and subscribe to the True Wealth Podcast on your favorite podcast platform. Follow us on Instagram, Twitter, or Facebook at True Wealth Pod. We'd love to hear from you. Share your thoughts, ideas, and questions with us on our social media platforms or email us at podcast@truewealthadvisors.ca. And who knows, your question might be the subject of a future episode.